Hello, ladies and gentlemen. Sanford Kahn here, business author and speaker. Welcome to this YouTube presentation entitled How to Survive a Financial Panic. If you get something from this video, and I sure hope you do, appreciate if you do me a favor. Appreciate it very much. If you could subscribe to my channel, hit the like symbol, that's the thumbs up, and leave a comment. Okay? How to survive a financial panic? Well, you might say, well, we don't have one. And it's doubtful we're going to have one. Well, think again. Let me give you an introduction before I give 4 ways of surviving a financial panic, and then I'll sum it up in 5 words that you could remember. Okay? We're in a massive credit debt bubble. A massive credit, historic. By any measure, it's historic. It was engineered in large part by the U.S. Federal Reserve by keeping interest rates very low for a long period of time, which encouraged consumers, governments, and the corporate sector, business sector, to load up on debt. And they did, massive amounts of debt. We're in a major debt bubble. Debt bubble. I'm taking the research from Harry Dent, who went back through history, hundreds of years, and studied all bubbles, all financial bubbles, including the famous South Sea bubble of 1720. And the number one rule of all bubbles, the number one rule, all bubbles burst. We're in a major credit debt bubble. So what could burst it? Well, the financial markets, meaning financial investors worldwide, should lose confidence in our ability to manage our financial affairs. And they already are. Remember, Moody's just lowered, well, maybe a few months ago, just lowered the credit rating of the United States. And it could be lowered again. If they lose confidence in our ability to manage our financial affairs, not only will the credit rating of the United States be lowered again, but interest rates will go up. We have to sell bonds to finance our massive deficits of over $2 trillion. They will raise the interest rate, especially on the 10-year Treasury. The yield on the 10-year Treasury governs interest rates throughout the whole economy. Throughout the whole economy. Car loans, mortgages, corporate debt, interest rate, everything is tied to the 10-year Treasury. If interest rates on the 10-year Treasury go up, really up, because investors lose confidence in our ability to manage our financial affairs, and we're not managing our financial affairs responsibly, they'll jack up rates. A financial bubble is dependent on low interest rates. Guess what happens? The bubble burst. The bubble burst. That's it. We are not spared from the forces of history. So yes, we can have a financial panic. When the bubble bursts, you'll have a financial panic. So how do you survive a financial panic? I'm only going to give you 4 ways. Actually, if you think about it, they're all really related. First of all, maximize your liquid savings. That would be money market, treasury bills, savings accounts in the bank, S&L, whatever, even stocks. Only trouble is, in a financial panic, the value of your stocks go down, but you do have the dividends from your stocks, so that's money you could put in your pocket. So maximize your financial assets, your liquid assets. Liquid, that would be things you could turn into cash real fast for emergencies. Money market is probably one of the best well-known. Most people have money in money markets. Second, reduce discretionary spending. That's on luxury items you really don't need. I mean, do you really need to buy another suit, another shirt, another tie, some more shoes? You know, do you need to eat out at really fancy restaurants? Cut back on your discretionary spending. I didn't say cut out. I said just cut back. Instead of going to a real fancy restaurant, well, there's always Denny's. A little humor here, okay? I think you get my drift. Just eat out, but go down a few notches. Don't spend as much. And what you don't spend goes into cash flow. And that can be put into money market. That's maximizing liquid investments. You could cut back on your discretionary spending. I've done that. I don't go out and spend big bucks, and I could, but I don't. I don't feel like it. Why? No, I watch what I spend, and I put it into money market or some good dividend paying stocks. And I'm not recommend putting it in good paying stocks. I just like stocks that could pay me money even if they go down in value. It'd be nice if they go up in value, but everything goes up all the time. Third thing, number 3, pay down high interest rate debt. That would be credit cards. Auto loans, if they're really high, or 11%, 10 or 11% or more, pay them down. Pay them down. Get the interest rates or the debt levels. I'm searching for the right word here, where they're manageable. You know, it'd be nice if you're out of debt, but I know that's not realistic. It is in a few cases, but most people, that simply is not realistic. So get your debt levels down where they're manageable, even if you don't have a job, because you have maximized your liquid savings, your money market and all that. You have enough liquidity, even without a job, to handle your expenses for 6 to 12 months. That brings up another point. Number 1, I would say maximize your liquid investments, like money market, treasury bills, and all that. What I should have also said, and most people, the rule of thumb is have enough liquidity to pay your expenses for 3 to 6 months. Well, that's nonsense. That's absolutely nonsense. Maybe at one time that was good advice. Now, at a minimum, you should have enough liquidity, short-term investments that can be turned into cash, to handle your financial affairs for a minimum of 6 months, preferably 12. That's why I'm telling you to cut back on your discretionary spending, pay down high interest rate debt. Number 4, this is something you should think about. Do not be totally dependent on your employer for your income stream. That is a mistake. Develop your own independent income stream. Maybe you can monetize your hobbies. You could do part-time work. If you're good in the trades, let's say you're good at fixing things, being a plumber, electrician, computer repair, handyman services, carpentry, something like that. Build that up where you could get income coming in from other sources. If you're just depending on your employer for your only income stream, they have leverage over you. You don't want them to have leverage over you. You want to have your own irons in the fire, income irons in the fire. Where you lose your job, at least you could have some income coming in, and you may be able to do it full time and make a living at it and not be dependent on your employer. Just an idea. Actually, all this could be summed up in one thing. Like I said, have enough liquidity to manage your financial affairs. I gave you four ways of doing it. There's more, but I gave you the 4 that to me are the most important. So think of it this way. Have enough liquidity, and remember these 5 words. Liquidity is king, not Elvis. Liquidity is king, not Elvis. Burn this into your conscious. Don't forget these 5 words. Liquidity is king, not Elvis. Okay? If you have the liquidity, that'll last you a minimum of 6 months, preferably 12. You could ride out any financial panic or economic downturn. Well, I think I spoke long enough. Actually, I spoke longer than I really wanted to, but I wanted to get my points across. So if you got something from this video, I would appreciate it if you could hit the like symbol, thumbs up, subscribe to my channel, and leave a comment. Okay? So remember those 5 words. Liquidity is king, not Elvis. Build up your liquidity, your cash flow. Take care now, folks.